Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Hurmaz Patakia. Well, a good day for the markets. That's initial surge that has stabilized at 24,550. Midcaps, though, they have come off sharply from the highs of the day. But so far, nothing much to complain. IT really batting it for the bulls.
It's an IT day. They're leading the charge on the index, and they are the ones that are keeping the gains there sustained on the index as well. So it's been a good day, but time to kick off today's show with the top headlines as we speak. The markets are hitting fresh record highs powered by frontline IT counters. Banks and financials to eke out some gains, but realty and capital goods are dragging. Midcaps relatively underperform.
Zee Entertainment shares surge over 6% ahead of Board of Directors meet on July 16th. Board to consider and approve the raising of funds through the issuance of appropriate instruments.
The IT index surges over 4% and is near a record high after TCS reports its first quarter results. Stocks like Coforge, Mphasis, Persistent and LTTS gain anywhere between 3 to 6%.
Oil India rallies in trade after brokerage firm Morgan Stanley. It raises its target on the stock to 663 rupees a share from 496 rupees earlier, while maintaining an overweight rating.
LT Food surges after it opens a facility in the United Kingdom as it aims to tap the rice and rice-based food market worth around £1 billion. The company expects annual revenue of £50 million over the next 2 years.
Okay, all right. It is an IT day, as Hurmaz mentioned earlier. It is supporting the Nifty, which is up to 40 points right now. Bank Nifty is also participating well, so that index is gaining around 0.6%. Needless to say, it's TCS, Infosys, all these names after TCS's numbers, which are surging in how mid-caps, they've come off from the highs. That index is up around 46 points, quite flat if you talk about the percentage levels, but it has seen those recovery from the red as well. Mid-cap IT space, that is something that you should watch out for. That is surging after that commentary about sequential growth by TCS has come through. But of course, we have a lot of individual names which we'll talk about in just a bit. But so far, a decent day.
It's a decent day, absolutely. There's no doubt about it. The Nifty was absolutely flat at the start of today's session on a week-to-date basis, and that has now turned into the green, courtesy all of these IT stocks. But there are plenty of movers in the broader markets, and Nigel is now joining in to take us through all of those. Nigel, good afternoon.
Well, good afternoon. Let's start off with the railway stocks. It depends on which side the train is going, but for today, at least it's moving up because you have all these railway-related names that are moving up. You have Railtel, IRCON, IRFC, all of them up and about, anything between 6 to around 16% in trade. SCI and SCI land, well, those have been some of the biggest movers that we have seen in this week itself. And as we speak as well, they are holding with gains of around 3.5 to 5%, but they're coming up on our radar because they're moving on very, very large volumes. Moving to the other big mover, IRDA. For this month, the stock is up close to 50%. Massive move is what we're seeing. And now some part of the street is drawing parallels between IFCI as well as IRDA's valuations. And they believe maybe there's a case for re-rating. For the time being, at least the stock is up and the volumes are very, very large. MMTC, one would have thought the stock should not be at current levels going by valuations. But the street thinks otherwise. Moving higher, up close to around 7% as we speak. A couple of other big movers. You have HPL Electric, big order win yesterday. The stock was up. Now it's still up close to around 12.5%, but it's come off a little bit from the day's top. Deonara India as well, that comes up on the radar in terms of some of the big movers, up close to around 8.5%. Let's add to the list a couple of bigger winners before we move on to the losers. Neogen, that's come back on the buy list. That's up close to around 7.5%. And KPIT Technology, the stock is up close to around 8%. Remember, Tata Elxsi had a tepid reaction to its numbers. But the largest vertical, which is the transport vertical, grew by more than 5% on a constant currency basis. KPIT Technologies, the entire business is in that, in that vertical. So that's why the street is bidding that up close to around 8%. Wind it down with some losers. Let's go with 3 to be precise. GE Power, stock had a big run. Now it's down close to around 10%. KCP Sugar, the street liked its number. The stock was up close to 20%, if I'm not mistaken, yesterday. And Go Digit, that stock is down close to around 6%. But it's a buzzing screen, lot of individual movers and shakers. Back to you.
Oh, yes, that's the point. It's Friday, right? So there has to be some action for sure, Nigel. But thank you so much for joining us. It's a good time to welcome Himeen Kapadia from KR Choksi Securities for a technical check on the markets. Himeen, good afternoon. Well, what next on the Nifty? Do you think the support from IT could continue? The mid-caps have been sulking a little bit, not performing as well as the benchmarks.
A very good afternoon to you, Sonal. Thank you for having me on the show. It's always a pleasure. I think IT is breaking out after a long time. Long time in the sense the all-time high, if you look at the Nifty all-time high, Sonal, was around 39,446 in January 22. We've now been 2.5 years into it to draw a top-to-top supply line, and we are overcoming that today. Needless to say, we're not very far away from here, and we'll walk into some resistance, but very interesting. Not fair to compare. Nasdaq has gone completely haywire in the sense new highs on a regular basis, and here we're on the cusp of taking out the earlier high. We haven't yet come there, but we probably will. So very interesting. If this gets taken out, Sonal, it's been 2.5 years between 26,000 and 39,000. So the upside could be humongous. I'm not jumping the gun, but there is a lot of promise. Let's hope it delivers. And yes, previous high needs to get taken out. So it could be a sector to watch out for. Currently, there's a lot of promise. We have to see it finally make the delivery, Sony.
Well, the Nasdaq going haywire is an understatement, right? I mean, considering the moves that we are seeing. First of all, good afternoon. Thank you for joining in. What about specific stocks then? Is IT an obvious choice right now, or is there something beyond that sector on your list as well?
Good afternoon, Varma. Thank you for having me. Yes, I think there is slightly beyond IT. There's nothing wrong with IT. But if it's all over the place today, I'm not sure if the risk-reward ratio remains in favor if you have a sort of a trading bet. So there are a few other stocks which hold promise. The first one is Asian Paints. Asian Paints has formed a base on the weekly chart. It's formed a rounding bottom. It's a bullish formation. Mechanical indicators are supporting the move. It's taking, and today's Friday, so the weekly charts will also form. It's going to take out the 55-week exponential moving average. Everything seems to suggest that we're heading for a further upside. So one can buy. It's just moved up in the last 10 minutes. So one can buy Asian Paints at 3050. Stop loss of 3000. Target of 3150. It's a small stop loss, small target. I believe it should be comfortably overshot. The second stock is a buy on SBI cards. This one has been cooling off for a long time, Hormuz, and we peaked somewhere in 2021. And from a high of 1160, we've come down to 650, and now things are looking good. This technical situation has improved not only in the short, medium, but possibly on the verge of a longer-term turnaround. But a medium-term bottom is in place. So a buy on Asian Paint, on SBI cards at 740, stop loss of 715, target of 790.
All right, Hemant, thank you so much for joining us. So those are some technical bets. With that, we'll slip into a short break. Management of Poly Medicure will join us next to discuss the budget expectations, business outlook, and more. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar, where we are very close to the budget, and government is likely to include a new scheme to boost medical device manufacturing in the country. Sources have told CNBC-TV18 that the scheme will be aimed at improving quality and reducing dependence on imports. Himanshu Baid, the Managing Director of Poly Medicure, is joining us now to take a few questions on the budget expectations and generally the industry trends as well. Mr. Baid, good afternoon. Thank you so much for joining us. I wanted to understand what is the percentage of imports coming in India right now, and if there is any import duty on that right now. What is the size of imports for medical devices right now?
See, I think as a percentage, I think we're looking around 70% imports, and I think the size is around close to around 50,000 crores of imports coming for medical equipment and medical devices, and the duty structure ranges from 7.5% to around maybe 10%.
So, Mr. Baid, good afternoon. Firstly, thank you for joining in. So, it's a pretty significant number that you have mentioned. What steps do you think the government should take in this upcoming budget to reduce that number firstly? And then if you could also give us an ideal duty figure. You mentioned 7.5 to 10%. Do you think that's the ideal import duty?
See, I think first of all, we need a couple of steps to maybe focus more on Make in India and import substitution. And I think PLI needs to be expanded. The earlier PLI scheme, I think, was still not fully utilized, and I think there are still some budgets remaining there. I think government should include a new maybe add a new PLI, especially for our products which are imported into the country. and maybe it'll take 4-5 years to arrest the imports. But I think if we can add another 1,000-1,500 crores by a new PLI scheme, I think that will go a long way in setting up more manufacturing in the country. I think the second thing is R&D and exports should be incentivized more right now, because there are very little incentives for exports and R&D. And I don't see that large multinational companies are looking at India as a manufacturing base. So to attract those companies, probably we need to bring in something more, and especially with focus on R&D and exports, and probably that could help us to ramp up manufacturing capability in India. I think on the duty part, I think the duty is quite appropriate. I think we don't have to increase or decrease it, because still we have a dependence on a lot of health. It's a healthcare basically, and we can't overnight change by making in India. So there has to be a gradual process. In my view, the duty is still okay, but I think more focus on PLI, R&D, and exports would be the right way to do it.
Mr. Baid, then a follow-up on the PLI. You said the previous PLI announced for medical equipments, it's not completely used. What was the reason for that? And if you expand it, do you think some changes or some tweaks need to be made in what was announced earlier?
Yeah, I think, first of all, I think what India lacks is a supply chain ecosystem for medical equipment and devices. So I think the focus should be more downstream, and what we can do more on downstream, and I think maybe PLI should be focusing more on downstream opportunities. And when we look at the first PLI scheme, I think the numbers, very stiff in the first PLI scheme. There was 60 crores incremental, revenue increase every year. And it was very hard for companies to do it 1 or 2 years, short period of time to scale up manufacturing. Because medical devices and equipment need more time to scale up, because of regulatory approvals and also, a lot of clinical approvals which we need to take. So in my view, the gestation period should be a little longer. And of course, it should be more on incremental revenue than a particular number which should be freezed every year. So that probably would go a long way, like the pharmaceutical scheme, where there's an incremental revenue of 10%. And if you move over that threshold, you get some kind of a PLI benefit. So I think here also we need to follow certain model like pharma.
And according to you, what should the ideal gestation period be, Mr. Baid? And if I can ask you a part 2 question here. Now, in when it comes to medical consumables, how has India progressed here? Because I remember when COVID happened, there was barely any facilities to manufacture the safety masks, the PPE kits, and then almost on war footing, this was done, and we almost became a net exporter of all of these. Now, what has the progress been on these medical consumables, say the gauzes, the pads, the wound care products, and so on and so forth? What's the progress been there?
See, I think the good news is India has got a lot of self-reliance on those kind of products where the technology is low and the barriers are low. But I think that reliance, and that has led to a surplus of exports in this sector. So I think our consumable import would be around $1 billion, whereas because that would include also some high-tech catheters and some kind of other products. But on the other side, we have an export of around close to $1.6-1.7 billion for consumables today. So I think there is a turnaround in this industry, and as the barriers were low. And I think as we go ahead and look at implants and larger medical equipments, I think we will need 4 or 5 years, but I think with the appropriate government support, we can also turn around this in next 4 or 5 years, in my view.
So, Mr. Baid, a follow-up on the export piece that you indicated earlier, that we need to incentivize exports. How much of the total medical equipment industry exports goods right now? What would that size be? For you, how much is it? And have you seen an improvement in export markets for you and for the industry as well?
See, totally, I think India last year exported close to $4 billion of medical equipments and devices. And that includes everything, it will include medical equipments and consumables, IVDs, and also implants. But I think the opportunity is much bigger for all of us. I think when you look at the global medtech business, which is around $500 billion. So I think, and if India is only contributing $4 billion as exports, we are far behind, in what we can do. And I think in last few years, because of the regulatory landscape changing, because of government bringing out standards, through BIS, I think a lot of changes have happened, and this will lead to more manufacturing. I think for Polymed, we have already seen our exports growing almost 25% year on year over the last few years. And I think that trajectory can continue to be, be the same in next few years, because as we add more products in the basket, as we add more manufacturing capability and capacity, I think we will see that happening. So there's a big opportunity out there.
So, Mr. Bed, is the growth better in export markets for you or domestic markets, or is it the same?
So I think at the moment exports are better for sure. As we compare last year, as we have already given out the numbers, we have grown only 18% in domestic business and 25% in exports. But I think we have grown over the market. Market is growing at 12 to 15% in India. But I think we have made some, added some new product lines. We'll launch new product areas like cardiology and critical care. I think that would lead to maybe an increased growth of now we should be in now close to mid-20s now in the current year.
All right, Mr. Bed, pleasure having you as always. Thanks a lot for joining in and sharing your views on the expectations the industry has from the union budget. Himanshu Bed there from Poly Medicure. Time for a short break here on Midcap Radar. We get you more on the markets and specific stocks. Stay tuned, back on the other side. Back with us here on Midcap Radar, and on the radar is LT Foods, and that is because the company has expanded its footprint to the United Kingdom and has inaugurated facilities in Harlow. Vamakshi is joining in with more details. Vamakshi, tell us more.
Well, absolutely. LT Foods in focus today. Keep in mind that the company had announced during its analyst call that they will be inaugurating the facility in the month of July, and seems like it has come through. LT Foods has inaugurated a facility in Harlow, and this is a facility which has a production capacity of 60,000 tons of rice per annum. With this, they aim to tap the rice and rice-based food market in the UK, which is worth almost £1 billion. In fact, they will be making an they've already made an initial investment of around £7 million, which is approximately 76 odd crores. And they also have a commitment to further invest up to £50 million, which is roughly around 540 odd crores in the coming years. They've also outlined the revenue generating potential from this facility, and they have said that they've already partnered with 4 leading retailers in UK, and they plan to scale this up further as well. They're expecting annual revenue to the tune of almost 50 million euros, 50 million pounds rather, and that could amount to nearly 540 odd crores over the next 2 years. And in fact, they're targeting nearly 100 million pounds within the next 5 years, which would amount to approximately 1,100 odd crores. So definitely a good development coming in from LT Foods. The stock as a result is surging in trade today.
Oh yes, 4% higher on LT Foods. It's done well in last 3 months itself, 35% higher on that stock. With that, let's move on and talk about the PSU space, because there's been a change in the retail shareholding. We're seeing a lot of updates, a lot of interest in those stocks as well. So how has this changed in terms of retail shareholding? Some of the names surging, and how have retailers participated?
Retailers have participated, and how it's been, retailers have literally piled into all of these names, and some of these companies have come out with shareholding patterns as of yesterday. I'll take you through some of them, and IREDA of course takes the spotlight first up, because that stock hit a record high today as well. 304 crossed that mark of 300. Market cap is now nearing 80,000 crores. Remember, IREDA's IPO was in November of last year, and since from that IPO price of 32 rupees, it's up almost 10x from the IPO price. And take a look at the shareholding pattern that was released yesterday, and you can see that the FPIs have doubled their stake from the March quarter. Now it's 2.7%. It was 1.3% in March. But the retail shareholders, there are already 21.2 lakh retail shareholders in IREDA as of March. That number has now increased to 22.1 lakh. So a significant interest still being generated on IREDA. That stock is already up almost 50% in the last month itself. Now BEL is the other one. That is the third best performer on the BSE index in 2024. It's up almost 80%. And if you take a look at that as well, in the last 12 months, the stock is up 160%. And if you take a look at that shareholding pattern, there is a bigger retail interest that has come in from there in BEL. The FPI stake, the DII stake, both of which has remained, the FPI stake has remained pretty constant, but the DIIs have trimmed their holdings from 18% to 16% now. But look at the retail shareholding, 13.4 lakh retail shareholders in March. That number is now almost 25 lakh. So that's almost double in just a quarter for BEL. BEL. And if you take a look at the returns as well, the April to June period, the stock was up around 45% during this time. So BEL, but the shipbuilders have been the ones that have been in focus all through last month, and Garden Reach also is one of them. The stock in the last 1 month had almost doubled in value, and Ramesh Damani is one of the key shareholders in the stock. He still continues to hold on to that 1.09% stake that he has. Now at current prices, that stake is valued at almost 320 crores. But take a look at the shareholding pattern there as well. The FPIs have increased their stake. The DIIs have trimmed their stake yet again. Here as well, HDFC Mutual Fund was the only one, was the largest shareholder, mutual fund holder here, almost 4.5%. That stake has come down to just under 2% now. So that reflects in this as well. So 2.5%. And the retail shareholding, 1.2 lakh, now it's up to 2.5 lakh. So Garden Reach there. And Mazgaon Dock, of course, lastly, pull up the shareholding pattern there as well. The FPI and the DII stake has remained pretty constant there, but the retail shareholding, 3.75, now it's almost 4.6 lakh. So retail shareholders are trying everything possible to be part of this PSU momentum. And of course, Mazgaon Dock does not have enough float, and yet you see that number on the screen there.
Yes, that's a big move that we've seen across these names and the big surge in retail shareholding as well. Thank you so much, Harmaz, for bringing us all those details. With that, we'll do one thing. We'll take your leave on this edition of Midcap Radar, but do stay tuned. Your stocks when we return.